If you've ever applied for a small business loan and been rejected despite having a great personal credit score, or if you've been approved but hit with an astronomical interest rate, you are dealing with a hidden link that traditional banks don't want you to understand. Most business owners think that once they get an LLC, their personal credit score doesn't matter anymore. Or on the flip side, they think a perfect 800 personal score automatically guarantees them a $1 million line of credit. Both of these assumptions are dead wrong, especially this year. Today, we are pulling back the curtain on exactly how lenders evaluate your credit profile under the hood. We're going to cover the precise personal credit thresholds you must cross, the separate business credit scores you didn't even know you had, and the 3-step framework to decouple your personal risk from your business operations. By the end of this video, you will know exactly what an underwriter sees when they run your file, and how to fix your profile before you submit a single application. Section 1. The personal credit myths. The hard thresholds. Let's address the elephant in the room. Your personal credit score is still the gatekeeper for alternative traditional business funding. Even when you apply using an EIN, modern fintech algorithms and underwriters use your personal FICO score as a baseline gauge for personal accountability. Here are the actual underwriting tiers you need to know. Tier 1, 720 plus FICO. This is the prime zone. At this level, you unlock premium, low-interest business lines of credit, traditional SBA-backed loans, and introductory 0% APR corporate cards. Tier 2, 650 to 719 FICO. This is the alternative funding sweet spot. You will get approved, but traditional banks will push you toward revenue-based funding or short-term working capital options. Tier 3, under 650 FICO. At this level, traditional options dry up entirely. You are now looking strictly at revenue-based cash flow financing, where approvals are based entirely on your daily merchant processing volumes rather than your credit history. But it's not just about the 3-digit number. An underwriter looks past the score at your utilization. If your personal credit cards are maxed out because you've been bootstrapping your business expenses, your score drops, and your debt-to-income ratio flags you as a high-risk borrower. This is why using personal cards to fund corporate growth is a trap. Section 2. Decoupling the SSN from the EIN, the business bureaus. To fix this, you must understand that your business has an entirely separate credit profile that lives completely independent of your Social Security number. While personal credit is tracked by Equifax, Experian, and TransUnion, business credit operates on entirely different scoring systems. The first is your Dun Bradstreet PAYDEX score. This score ranges from 1 to 100, and unlike personal credit, which takes years to optimize, a PAYDEX score is mathematically based on one simple metric: payment history. If you pay your vendors exactly on time, you get an 80 score. If you pay them 20 days early, you hit a perfect 100. The second is Experian Business and Equifax Business, which generate risk models based on your credit utilization across corporate accounts, public records, and UCC-1 filings. The ultimate goal for a growing company is to establish business credit lines that do not report to your personal credit bureau. When you secure an EIN-only credit facility, that debt stays completely invisible to your personal credit report. This means you can draw down $100,000 to buy inventory or scale marketing, and your personal credit utilization remains at 0%. Section 3. The 3-step compliance shield to get approved. So, how do you build a profile that lenders actually trust without relying on a personal guarantee? It requires passing an automated compliance check. Before a human underwriter ever looks at your financial statements, an AI system scrubs public records to see if your entity is actually legitimate. If you fail any of these 3 steps, you get an automatic denial. Step 1. Absolute entity matching. Your LLC registration, your IRS, EIN letter, your business bank account, and your online utility bills must match word for word, comma for comma. If your bank account says Main Street Holdings LLC, but your utility bill says Main Street Holdings, the algorithm flags it as an unverified business. Step 2. Commercial footprint. Lenders will automatically reject applications that use residential addresses or standard P.O. boxes as their primary business address. You must use a true physical commercial address or a verified virtual business address that registers as a commercial location in USPS databases. Combine this with a dedicated business phone number listed on 411 directories. Step 3. Clean data banking. You must stop commingling funds immediately. Running business revenue through a personal account or paying personal bills out of a corporate account destroys your fundability. Lenders want to see a clean, dedicated business checking account with a consistent average daily balance. Section 4. What to do if your score is bruised right now. Now, what happens if you need capital immediately to expand or handle a cash flow crunch, but your personal credit score is currently damaged? You don't have time to wait 6 months to build a perfect corporate profile. This is where alternative financial architecture comes into play. If your personal credit is under a 650, you must shift your target away from traditional banks and toward revenue-based financing and select funding structures. Alternative lenders look at cash flow liquidity rather than personal history. If your business has consistent monthly deposits, stable point-of-sale daily batches, and a clean banking history over the last 90 days, you can unlock significant working capital lines. The trick is using that fast capital injection to scale operations while simultaneously building your Tier 1 vendor trade lines in the background. You use the revenue-based capital to fund the business today, and use the trade lines to build an independent EIN credit profile so that next year, you qualify for prime, unsecured lines of credit. To recap, your personal credit score gets you through the door, but your business compliance and cash flow dictate how much money you actually get and how expensive that money will be. Stop risking your personal home, your savings, and your family's financial security by personal guaranteeing everyday business debt. If you want to stop guessing what lenders are looking for and get a clear, step-by-step blueprint to build your corporate credit shield from scratch, or if you want to see exactly what funding programs your business qualifies for right now based on your current revenue, we can help you map out the entire process. Click the first link in the description below to access our credit building resources. And let's get your business standing firmly on its own 2 feet. If you found this breakdown valuable, make sure to hit that like button, subscribe for daily small business funding strategies, and I'll see you in the next video.